Now start with our discussions on Unit 5 of Financial Reporting and Analysis, and we're going to cover cash flows in this unit. Cash flows are an important part of overall financial analysis purely because they capture stuff that is not directly captured in the other two financial statements, right? So when we look at cash flows are essentially what capture the cash movement of a company. Remember, businesses survive, or businesses, the sole purpose of businesses is to make profits, right? But those profits need to be realized. When I say realized, it basically means that you need to generate cash out of those profits. If you do not generate cash out of those profits, at the end of the day, they would be treated as paper profits, right? For example, I can sell you something for rupees 100, that's the sales, and it might cost rupees 50, which means the total profit should be rupees 50, right? But if you do not pay me this money, which means we are talking about a receivable, right? If I sell you the good and this is a receivable, then technically I have not received 50, I am at minus 50 because I've paid 50 and I'm yet to receive this 100. And that is the crux of how do you treat a cash flow with importance, because a lot of the times cash flows can create uh, you know an understanding which the P&L does not give. Profit and loss accounts are accrual basis statements, and because of accrual basis statements, there are a lot of opinions that go into the profit and loss account. Cash flows do not get affected by that problem. So we're going to cover what is a cash flow statement, what are the uses and limitations of a cash flow, direct and indirect cash flow statements, how to look at a sample cash flow, and what can we learn from cash flow statements, right? So when we look at a cash flow statement, it tells us about the cash receipts and payments of any company. It's the amount of actual cash inflow and outflow. So technically, this is like a bank statement, right? In a way, a bank statement. And just like a bank statement, these are all actual transactions that will come out, right? Remember, in our discussion on P&L, we had said that there is a scenario of revenue recognition. Revenue recognition can happen for, let's say, a long-term project. So if there's a long-term project that is for a period like 3 years, then how much do you book in the first year, right? In that case, there is some sort of an opinion that comes into picture. So let's say there is a 3-year project for building a bridge worth 3000 crore. Now, it's quite possible that in year 1, 2, and 3, you're booking 1000, 1000, and 1000 of sales, but your cash flow is just 3000 at the end of the third year, right? It is quite possible that this scenario is happening. So effectively, it is important for us to understand that it gives us an idea of the accrual accounting to the cash flows. At the end of the day, cash that is needed to keep the business running. If you don't have cash, the business will cease to run. You might be profitable, but if you do not have money in your hand, how are you going to pay salaries to your employees? How are you going to pay the expenses? How are you going to pay your suppliers? So it is absolutely imperative that cash flow statements are analyzed in detail. We already know that cash flow statements capture all the cash transactions of a company. P&L statements capture the business transactions, which is I sell something, I pay an expense for it. But cash flow statements typically capture if any cash has come into the company and if any cash has gone out of the company, right? Now, these two are very, very important points that we get. Cash flow statements broadly get divided into 3 parts, right? So when we look at cash activities, you could have either activities related to operations. You could have activities related to any kind of investments that the company has done, and you could have activities related to, let's say, something like the financing of the company, which is how do you raise money, right? Raising and repaying of money, all those get captured here. Now, if you think about it, the operations bit typically deals with the P&L statement. Largely, what have you sold, what have you received, that is your operations, right? Investment side will largely deal with the asset side of the balance sheet. You buy a fixed asset, you sell a fixed asset, you buy investments, etc. Financing side typically deals with liabilities, which is you are looking at raising money through debt, you're looking at raising money through equity, repaying money through debt and equity, and so on and so forth, right? So that's the crux of the cash flow statement that we look at. Now, we will realize that there are some changes to these when we look at them in detail individually. That would probably form a part of the next section. But at this point of time, let's just understand that most of the times when we divide a cash flow statement into these three headers, which is cash from operating activities, cash flow from financing activities, investing activities, and cash flow from financing activities, they would capture separate transactions in each of them. Any cash flows due to operations of the firm, which is sales, expenses, basically running of the business, these are related to activities from the P&L statement that comes under cash from operating activities. Any cash flows due to investment activities such as buying, selling assets, usually you can relate this to activities from the asset side of the balance sheet that comes under investing activities. And any cash flows due to financing activities such as raising and deploying money or repayment of money, all this comes under financing activities. Usually you will find this on the liabilities side because that's where you will raise money, that's where you will deploy or repay money from. So effectively that's your cash flow statement division. Any transaction on the cash flow statement, any cash inflow or outflow has to be a part of one of these three, right? It cannot be outside any of these three. You will either use money in business operations, you will do some investment, or that would be a financing activity. It cannot be anything else other than these three, correct? Now, what are the broad uses of the cash flow statement? This is an important idea. It gives us an idea if we are generating enough cash fast enough. If we keep seeing negative cash flows over years, this is not sustainable, right? This is not sustainable. At some point, you will need money to be able to run the business. It gives us an idea if we are overburdening the company with debt, right? Or an aggressive capex plan, which basically means that you find that cash flow from investing is negative and cash flow from financing is positive, which means you have raised money, correct? And you have invested. And if you keep doing huge numbers in this over a period of time, there could be, it gives us an idea whether you are overburdening the company there. It tells us if the company will need financing in the future. If you see negative CFO continuously, then at some point of time you will need money to run the business, right? Or if you're seeing negative cash flow from investing, at some point of time you will need money to do all those investments, right? It tells us if we have enough money to meet any unexpected cash requirement. It is a guide to business cycle and processes, which is how and when is cash collected. Once you sell, when does the cash come in? So cash flow tells you how much of your sales gets realized from time to time in terms of your sales. How much of sales get realized, how much of expenses get paid from time to time. And that gives a guide in terms of how much money you are expected to make given a certain amount of sales and profit. it can help us design financial policies around dividend, credit terms, when to collect money from the clients, when to collect from clients, correct? Or customers. That's basically what will get defined based on how much leeway you have and how much cash you are generating. And it can help us identifying causes of any cash shortage in the business. So where is the cash getting drained out? That is what is going to come from the cash flow statement, right? In general, it tells you if cash is needed, if business is generating enough cash, if you're taking a lot of debt, overburdening the company, if you're doing capex too fast, if you're doing an aggressive capex, if you're raising enough money fast enough in terms of the business, and how do you define your dividend policy and credit terms, etc. This is all a part of the uses of the cash flow statement, right? Now, let's look at a couple of quick broad interpretations of cash flows, right? I have two companies here. There is a company A and there is a company B, right? Let's just look at these statements for a while. Company A has a negative increase in cash, which basically means this is a cash outflow. Company B has a positive number here, which means this is an inflow. Now, so on prima facie evidence, it looks like B is better than A, right? Now let's decode it better. Let's look at company A. It's generating 100 crore from operating activities. It is spending minus 150 on investing activities. Looks like it must be doing some capital expenditure. What is capital expenditure? They must be increasing capacity, correct? So they must be increasing capacity. That's why minus 150, which means there's an outflow that is happening here. So this is an inflow. I'll just write in and out. This is an outflow. And if you look at financing, this looks like an inflow. So they needed 150 crore. They generated 100 out of their business. They had to take another 40 as possibly take debt, right? So technically they took another 40 as debt, and minus 10 means that 10 came from cash reserves. So you needed 150 for capex, you got 100 from operations, you got 40 from debt, and you got 10 from your cash balance, right? Which is fair enough. While it looks like a negative cash year, it is fine for a company to expand in a certain year by using largely proceeds from its own operations. So about 65% of the money is coming from here, nearly about approximately 25 to 30% is coming from here, and the remaining is from your own cash balances. So for all practical purposes, nearly 70% funding of this capital expenditure of 150 is happening either from operations or from your own cash, which is not bad, correct? They're not overburdening the company with debt. Let's look at company B now. In company B, you see negative cash from operating activities, so that's an outflow. You have positive cash from investing activities, so that's an inflow, and negative cash from financing activities, so that is an outflow. Now, when you have negative cash generated from operations, it could be either you have not received money or you have made losses, right? When you see negative numbers here, it means you have repaid money. You have given a loan repayment, you have done a loan repayment, or you probably have paid dividend, or you have repaid money in some form or fashion to the people you raised money from, right? Now, it seems that this company needed 100 crore to be repaid. They did not generate anything from operations. They actually lost money in operations. So now they are minus 200 down. How do you make money? You make money by selling assets. Now, when you sell assets, you will always get money, right? But that does not necessarily show a good scenario. So at the end of the day, it shows like 250, but what's happened is you wanted to repay money, and to repay money, you had to sell assets because operationally you were either not making money or not receiving money, correct? Now, even though the second company shows a net increase in cash, we see that they're doing it by selling assets, and that is not necessarily a great sign in the context of understanding a company. What point we are trying to make or understand is that sometimes just looking at these three line items from the cash flow, you can figure out if the company is in trouble or if the company seems to be doing fine. So if we look at these two companies, it seems obvious that this company seems fine. For this company, it is business as usual because they seem to be doing their expansion, funding it largely from operating activities. Company 2 seems to be in trouble because they seem to be selling assets in order to be able to repay loans and in order to be able to run the business. Now, you cannot technically run the business. This is a short-term measure. You cannot technically run the business for long periods by selling assets. If you don't have any assets, how will you run the business in the first place, right? So even though this looks positive, it is these three components that give us an idea about how good or bad the business is doing, what is the strength of the business, and that is one of the primary uses of the cash flow statement, which we were not capturing so far from any other kind of statement, right? So it is important for us to understand when we look at cash flow statement of a company as to what the company is trying to do. Now just try and gauge at your end, think about it as a small project. What happens if a company generates 100 here, if a company is doing a capex of 500 here, and if they generate 400 here, right? Now, technically, they are doing, this looks like capex, so that's fine, they're increasing capacity, but in this case, they seem to be funding bulk of the capex, funding 80% of this 500 from debt. Now that could increase the loan burden significantly for the company. So sometimes just these three line items give us a fair idea about what's happening with the company. When you're looking at a company's statements, just put these three line items together and try and understand what is happening with the company in terms of cash flows, right? That brings us to an end of this particular section. Couple of quick questions. What are the major uses of a cash flow statement when you look at the context of P&L, balance sheet, and cash flow? Explain how a cash flow captures things which a P&L does not. Thank you.